Hi, welcome to Trade Zone on the 17th of May, presented by Track Record Trading Academy in partnership with Eightcap. So let's go. We're going to talk about what's important on the data calendar this week. It's pretty quiet week, not much on the data calendar, but there's one thing we should talk about. And the lagged effects of the U.S. Federal Reserve's policy. See what we think about how they will continue with their hiking cycle, and we'll round up the day with a trading tip because it's a quiet week, right? So it's good to revisit what are the habits that will lead you to success. So important on the data calendar this week for the rest of the week is only the Australian employment number tomorrow, and it's expected to show that jobs increased by 25,000 in April. It's smaller than the 53,000 increase in March, but still it will show that it's likely to show that the jobs market is still healthy, is still growing, and that should keep RBA on Reserve Bank of Australia on its toes. How will the market react to it? If it's a stronger than 25,000 jobs added, it's likely that the Aussie will have a small rise, and given that it's come off quite a lot, and it is likely to reinforce the hawkishness of the Reserve Bank of Australia, increase the likelihood of more rate hikes going forward as well if this job market surprises to the upside. If it's expected or slightly weaker, I think it's not going to have much of an impact. It's pretty much what the RBA wants anyway, so it's not going to change their rhetoric. But if it's much weaker, it could add to the pressure that the Aussie has been feeling for the past few days. That's it. And on to the Fed policy, right? So we know so far, if you recall, the Fed said that inflation was transitory in 2021 as it was rising. It was transitory to them, but they expected inflation to slow down. It was a temporary spike in inflation, and then they said that they're targeting average inflation, so they are comfortable with inflation being above their 2% target because it was below the 2% target for many, many months. So they're very comfortable with that. And that changed at the end of 2021. In around November, December 2021, they started to say that, it is not really transitory. It's going to go higher, and we're not comfortable with that anymore. And they started reacting to it. And as you can see, it was many, many months of below target until mid 2021. Then it started to rise, and when it rose, it spiraled upward continuously for many, many months till mid 2022. Then it started to come off, right? So what we have here is if you recall, in early 2020, because of the COVID crisis, Fed cut rates to zero, and then it took them about more than a year before we started seeing the spikes in inflation that they were not comfortable with. They saw it for a few months, and then they said, we are not going to tolerate this anymore. And then it took them some time to it took them a year later, to more than a year later, to have to hike rates for the first time. So it's likely that there's two things to observe here. One is that monetary policy does not impact the economy immediately. It feeds through the economy. It takes months, and quite a lot of months. In fact, more than a year. Some estimates are up to 2 years before the full impact of the interest rate changes are felt in the market. So if that is the case, we are going to be seeing the impact of the first hike, which is in last year March. We are starting to see that in the economy, right? Since the first hike, they have hiked a cumulative amount, a total of 5%, and that's a very, very aggressive rate hiking cycle. So we are likely to see more of these effects impact the economy going forward. So even after Powell, Fed Chair Powell acknowledged that inflation is no longer transitory, it took him a few months before he started hiking, right? So that's likely to be the case again. We are likely to see inflation continue to run upwards as well in those days before they started to hike. And once they hike, it's continued to go up for a while for months before it started coming down. So there's a lag effect. There's also a delayed. There's also a delay in reaction from policymakers. They tend to act very, very slowly, and it's likely to be the case going forward as well. So policy action tends to be very slow when they react to inflation, because inflation takes some time to filter through. So what happens when inflation goes down? So we are seeing inflation going down. It's been going down for 10 months in a row. And But the Fed still thinks that inflation is still persistent and high, too high relative to their target of 2%. But as we have seen, it takes time for a full impact of the interest rate hikes to filter through the economy. So I believe that we have seen the peak in inflation is likely to continue downwards, and we will, although the Fed wants to hold rates for higher and for higher for a longer period of time, this is very reminiscent of what they said when they said inflation was transitory. So they're very comfortable with inflation being high at that time because they were in the mode of easing. They were in the mode of keeping interest rates very low for a longer period of time. So they actually did promise that there will be no change in interest rates in 2022. Of course, they changed that in a flash when they started to panic. And I think the Fed will be slow to react again. That has been their history, but that's the way that policymakers tend to work, tend to conduct monetary policy, and we're likely to see that happen again this cycle. So, likely, the likelihood is that very high likelihood that we're going to see more of this lag effect starting to show. Some of this is we see this in the failure of US banks. We've seen several banks failing now because of deposits flowing out of the banking system, because interest rates that are being paid by these banks are so low compared to what market interest rates are prevailing right now. So they could and they are seeking higher returns from investing in treasury bills, in money market funds. And also a lot of these banks, in fact, a very high percentage of the banks in the US, and likely also in many countries around the world, where they have seen a steady rise and quite aggressive rise in interest rates in the past year. Most of these banks will have bond and loan portfolios that are underwater, right? They will have losses on the books, and that will start to show. And even, of course, most of these are not marked to market, but they are bleeding slowly. And as time passes, as interest rates remain this high, they have to borrow at these rates to fund the loans that they have made at much lower interest rates. So they are losing all this money slowly. It's a slow bleed. So we will see these lag effects starting to show. And one of this consequence of having a bond and loan portfolio that is bleeding and underwater and continues to bleed is that they will find it more and more difficult to make new loans, because as the deposits dwindle, they have less money to lend out. And also they will have to tighten their loan giving, loan making criteria as they start to feel pressure on their balance sheets. So when inflation falls, I believe it will fall hard, much like the way it was when it was rising. When it starts rising, it becomes entrenched, it starts rising aggressively. We are likely to see that. When inflation falls, we will likely see a spiral downward, and it will be having pressures from this inflationary pressures from the AI boom as well. AI, artificial intelligence, as we have seen, is increasing productivity in certain sectors right now, and yet it is not yet widely used. But the developments in this area is speeding up. Google, which is trailing behind ChatGPT, OpenAI's ChatGPT bot, is now trying to play catch up. Microsoft has already implemented the chatbot into their search engines, so we're likely to see more of these productivity gains being implemented across many different sectors. So that we will see disinflationary pressures from this front. It will cause wages to fall as well, especially the service sector, the sectors that requires intellectual output. I think eventually the Fed will react, but they will be slow. They are still insisting that they will keep interest rates higher for longer, and still insisting that there may be need to hike further. But as Paul Tudor just said recently, he thinks we have seen the last interest rate hike from the Fed, and I'm not sure yet if it is the final hike, but I think it starts to matter less now, because if they're going to hike again, it's going to be likely only 25 basis points, a quarter of a percent. It's not going to make much of a difference to inflation or otherwise, but it will create a lot of pressure on banks and other businesses as well. Commercial real estate, for example, they are all underwater from since the interest rate started to rise from 0 to currently 5%. So that's my thoughts on the Fed policy going forward. We are going to see lagged effects, and in fact, the Fed will also be very slow in reacting to new data as it comes out. So since it's a quiet week, we're going to talk about trading tip, and one of the things that I think many retail traders have a misconception about is that they need to trade frequently, and they mistake activity for productivity. So the misconceptions that most retail traders, especially the beginners, have is that the trading is about having a high win rate, and you see this being propagated by many of the streamers, so-called trading gurus as well, because they're essentially, most of them do not really have a trading background. They're not well versed in proper structured trading process. So they think that having a win rate is what matters, and hence they tend to trade more. They tend to overtrade, and they have this misconception that there's a higher number of wins will overcome the losses. So they tend to take profits very frequently, and they let their losses run because they think unrealized losses are not really losses. So they do not want it to impact their win rates. So they keep their losses and hope that it comes back. And then when they're slightly in the profits, they close the trade. So these are all very bad habits. So the misconception is more winning trades equal to more profitability. Of course, it makes sense that way, but it is also about the size of the winning trades. If you have many small winning trades and one big loss, it doesn't mean that you will be profitable. It's likely that you'll be in a loss as well, because most of the accounts that suffer losses are due to one or two big losses, because they don't know how to stop out, and they are frequently taking profits too frequently. So do not mistake activity for productivity, because it will lead to bad trading habits, and more trades do not equate to more profits. In fact, it leads to overtrading, and overtrading is not a good thing, right? Having too many trades, it distracts you from the real opportunities that often occurs in markets, right? So having too many trades is a problem. And also, if you start to have too many trades, it's likely that most trades are not really well thought out. It's mainly a reaction to boredom. You just feel that you must have some trades to keep it going. And this is important in current market conditions, because markets have been in a range for a few weeks now. you see in the headlines, you see in much of the financial media, they're talking about why volatility has been so low and why markets has been stuck in a range. So you should, it's always important to take a step back when markets are not giving you clear opportunities. Take a step back and concentrate on the longer term. So how should we go about it? We traders, successful traders, tend to have a structured trading process when it comes to trading. It's essentially a checklist of what is required before you execute a trade, and that helps to remove emotions from trading, such that you will not be chasing trades, you will not be overstaying in trades that are going wrong, and also not giving in to FOMO, which is the fear of missing out. If you have a structured trading process, it becomes more likely. It becomes more likely that you only execute trades that have gone through a checklist, a set of criteria that you set for yourself. That means that there will be less trades that are due to emotions, that are due to boredom, due to just because of some tip from some friend, right? And it helps you to avoid bad trades, which are trades that have no good risk reward profiles, and trades that are basically in the longer run, regardless of short-term outcomes, in the longer run will lead to financial losses. So why are more trades detrimental? It makes the trader tends to overtrade. Overtrading leads to not just financial losses, but it becomes your mental capital. So it's important to think that it's not just financial capital that is being at risk, also mental capital. It depletes your mental capital. It stops you from focusing on the overall bigger picture and stops you from seeing the true opportunities that often come by. And more importantly, there's a cost of trading. There's bid offer spreads. There's also carry costs depending on the platform that you're trading on. So it all adds up over the longer run. And in the words of a legendary trader, money is not made by trading, but it is made by sitting and waiting for the right opportunities to come by. Thank you very much. Thanks for being with us today. And I'll see you next week, where we will find some time to talk about what a structured trading process looks like. As always, thank you for being with us. Take care. Stay true to the process. This is the process I'm always talking about, the investment process. And eventually, it will lead you to successful habits that will lead you to the success that you wish for. Take care. Bye-bye.